Now, remember, my timing is not your timing. My timing is a longer term time horizon. I'm really trying to time this as a business cycle, so that's into the end of 2025. That's my time horizon. I don't trade around. All I do in sell-offs is add if my view hasn't changed. We have needed stimulus into the global economy because the economy has been slow. The ISM survey has been bumping along the bottom. China's slow, Europe's slow. And you see, one of the component parts that allows for this all to move hadn't really been playing ball. Firstly, it was US rates, but the Fed gave us that signal. So that started moving. But the big one is King Dollar.
Raoul begins by addressing the current state of the markets, noting the widespread concern and confusion among investors. The volatility we're witnessing is part of a larger macroeconomic phenomenon, a macro spasm as he calls it. These spasms are significant, albeit temporary, disruptions in the market, typically occurring around regime changes in monetary policy or economic cycles. To understand the root of the current market turbulence, Raoul emphasizes the importance of looking at the bigger picture. He explains that his investment strategy is focused on a longer-term horizon, extending through to the end of 2025. Unlike short-term traders, who may struggle to navigate the volatile crypto markets, Raoul advocates for a buy and hold approach, particularly in times of market uncertainty. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Everyone's like, what the fuck is going on, Raoul? I'm getting millions of messages. Where's our fucking banana? I get it. You know, these things, these macro spasms, they happen from time to time. So let me talk about what's going on right now, the slightly bigger picture framework, so you can understand why I think what I think, and then we'll tie it back down to markets and even a bit about the banana zone. Now, remember, my timing is not your timing. My timing is a longer term time horizon. I'm really trying to time this as a business cycle, so that's into the end of 2025. That's my time horizon. I don't trade around. All I do in sell-offs is add if my view hasn't changed. And I'll show you how my view hasn't changed. So if you are a shorter term time horizon, I can't really help you because I think that's a very, very difficult thing to do in crypto markets. You know, some of my all-time favorite traders and investors, kind of legends of the industry, who are very big into crypto, they say, well, I'll never trade it. Even though these guys were famous for trading, they're like, buy and hold works much easier, it's much less stressful, and you don't get caught out with a massive volatility. Anyway, so what the fuck's going on? Why are the markets puking? Why is everybody gripped with fear? Well, it's a story of the yen. But the yen is not the whole story. The story is actually much bigger. You see, what's been happening is we have needed stimulus into the global economy because the economy has been slow. The ISM survey has been bumping along the bottom. China's slow, Europe's slow. And you see, one of the component parts that allows for this all to move hadn't really been playing ball. Firstly, it was US rates, but the Fed gave us that signal. So that started moving. But the big one is King Dollar. The dollar has been strong, and a strong dollar is a tighter financial conditions, which doesn't help markets and doesn't help economies. You see, at this point in the cycle, when there's no inflation, or inflation is falling fast, generally you need a weaker dollar. That brings global growth. So if you remember, Janet Yellen went to China twice earlier in the year. Those conversations, I believe, were about how we can allow China to stimulate without sacrificing the yuan. You see, if China had stimulated with the dollar strong, the yuan would have collapsed, and they can't deal with that. They really want to keep their currency stable. So they will have said to the US, we get it, we need to stimulate, we've got a debt deflation going on, but we can't stimulate, you need to help us. And Yellen would have said, of course, what can I do? And the answer is, well, obviously you need to cut rates. And that's like, yes, we understand that. That's on the cards. But then it's like, you must weaken the dollar. So cut to the Bank of Japan. The Bank of Japan is the big player in all of this. And the Bank of Japan had been suffering from a weaker and weaker yen and the stronger and stronger dollar, and had started to make noises that it wanted to do something about it. So the Japanese banking market is the Eurodollar market. It's the global lending of dollars, really comes out of Japan. And Japan didn't really have enough dollars. So what they had to do, the world doesn't have enough dollars. So Yellen will have spoken to the Japanese, as will have Powell, and the idea is this, listen, you intervene in the currency, that's injecting of liquidity. Help us start lowering the dollar. You can be the big driver here because this is how you operate your currency system. We will reciprocate by cutting rates. And the Chinese will be able to stimulate their economy without losing control of their currency. That's something I wrote about for a while, and I've talked about that this was the big plan. So we started to see yen intervention. Now, the thing about the yen, as the Japanese also raise rates, the thing about the yen is that a lot of people borrow in the currency because it's cheap, and then they invest in other assets. It's called the funding trade. And that's all well and good, and it can deal with normal volatility. But once the Japanese started to intervene in the currency, it starts knocking people out of their positions. Those positions become less profitable. So what happens is they are forced to reduce risk. In banks, it's called VAR and hedge fund, which is value at risk. So if the currency moves a lot, their funding currency, or in fact, any major currencies, what they have a tendency to do is start having to liquidate other positions. That started knocking into the NASDAQ, riskier assets, as people start reducing the higher volatility positions, and it knocks all the way through the chain of all assets. That's why you get this correlation of one event when everything moves together when they weren't correlated before. It's because everybody's forced to puke risk at the same time.
Raoul points to similar events in 2016 and 2018. In both cases, the markets experienced sharp corrections due to strong dollar conditions and subsequent interventions. However, these corrections were followed by significant rallies as central banks injected liquidity into the system. Raoul suggests that we are currently in a similar situation, setting the stage for another potential market rebound once the volatility subsides. Raoul remains optimistic about the future. He argues that the current market conditions are setting up a magic scenario for investors who can weather the short-term volatility. With central banks likely to inject more liquidity into the system, Raoul anticipates a sharp recovery in the markets, similar to what was seen in the past after macro spasms.
So the risk puking had started and then really started to gather steam. Now, for all of us, this is like, what the fuck are you doing? You're nuking my bags. I get it. But again, there's a bigger game to be played. The bigger game is they want liquidity into the system. And to do it, you're going to have a regime change, and that creates a macro spasm. Now, these macro spasms are not uncommon. You tend to get one every business cycle, particularly around regime changes. So, we saw one in 2018. That was at the end of the hiking regime. We saw then this spasm as the market essentially forced the Fed to pivot, the Powell pivot moment. But actually the most similar was 2016. Early 2016, the dollar had been so strong, it had pressurized global commodity markets. The Chinese were under huge pressure with their economy, as were the Europeans, and we needed to do something. Yet again, the Japanese started the ball rolling by starting to intervene in the currency markets. That pushed down the dollar, and a big unwind happened. Markets puked for a short period of time as this happened. But the Fed then stopped hiking. They was just starting the hiking cycle. And if you remember, they then stopped for an entire year. But others managed to massively inject liquidity because of the weaker dollar. And what did that do? Well, it set off markets after this spasm into a huge bull run. 2018, a huge bull run, because what you're allowing is the injection of liquidity, more cowbell. So that's where I think we are today. We're setting ourselves up for liquidity, but we need to digest the volatility of the currency move first. Now, how long will that take? Usually, it takes a week, 2 weeks, 3 weeks, sometimes 4 weeks. We've got the added complication of what's going to happen in the Middle East. I don't know the answer to that. But anyway, these are the kind of factors we're playing with. And I think of them as spasms. These are short-term macro things that don't affect the view. You see, something like this can be really problematic if the business cycle peaked and we're on the way down. That's what tends to exacerbate slowdowns. If the business cycle is rising, driven by liquidity and financial conditions, which is what it has been, and I'll show you some stuff on this in a sec, then these tend to be short, sharp corrections, a pause that refreshes, a kind of resetting of leverage in the system that allows the markets to recover, and often very sharply because it's followed by liquidity. You see, when the cycle's falling, it usually means inflation's too high and therefore they can't inject liquidity and don't want to. But this is the reverse, right? So this is actually a magic setup.
Raoul briefly touches on the geopolitical risks emanating from the Middle East, acknowledging that these could add another layer of complexity to the market dynamics. However, he remains focused on the broader economic trends, which he believes will ultimately drive the markets. Raoul concludes by reminding investors that these macro spasms, while unsettling, are part of the natural ebb and flow of economic cycles. For long-term investors, the key is to stay focused on the bigger picture and not get caught up in the day-to-day volatility. By understanding the forces at play, investors can better navigate these turbulent times and position themselves for future gains. Please like and subscribe my channel.